Welcome, welcome to Accounting 401 Introduction to Taxes. My name is Charles McCarr. I will be the instructor for you this semester, spring 2023. I'm sorry about not getting the syllabus to you earlier, but last Wednesday, a message went out from the Vice President of Academic Affairs saying that they are revising the syllabi after I had mine done. So I have to make some changes to it to get into compliance with what they want as essential elements contained therein. But I will get that out to you shortly. I don't know if we have a textbook yet or not. We're going to be using McGraw-Hill's individual taxation. I'll get you the ISBN number, and you can get the e-text or you can get the hardcover e-text. I think is a little bit cheaper, but it's a book I've used as long as I've been at Misericordia for 10 years teaching taxes, and it's a fairly good book. It gives a lot of nice examples and exhibits in each chapter. They also start each chapter with learning objectives and a little story that pertains to the material contained in the chapter, storyline summary, featuring a person. I don't know if they're real or made up. They have a picture there for everybody. And it kind of brings the theoretical that's in the text into the practical world that people face each and every year, each and every month and day of working and thinking about the federal income tax that they have to pay. The first chapter, and again, we're not going to get in, the first 2-3 chapters are, I don't want to say historic profiles about the income tax, but it's basically background material to give us a better understanding of how the federal income tax system works and how it operates and a lot of theory behind it. Then we'll get into the nuts and bolts of the tax code as it pertains currently. December 17th, 2017 was the last major last change to it. It changes every year. We'll see this and I'll note it as we get into different topics. A lot of items, when we see numbers, the numbers are usually indexed for inflation for certain things and thresholds and qualifications for certain credits and all. So one thing I want to get up front, and I'll reiterate this when we get on those things. The numbers are only important for a given tax year because those numbers change from time to time. The important thing is to understand the concepts of the different credits, the different deductions, and the different items of income, which is what we will be concentrating on. Yeah, the numbers are important. A good example of that is the Social Security tax. It is actually 2 taxes in one. There's the old age survivor's disability, and then there's the Medicare part, and it's split half and half. Well, actually, it's not. It's half and half between the employer and the employee has to pay it. The Social Security is, I don't know, 4.65%, and the Medicare is 1.45%, I think. But the thing is, with those percentages, they've been pretty constant for the last generation or so. What changes is the tax base. Years ago, it capped out at $70-some thousand. I believe now it's in the low 140, like $143,000 or something. And that pertains to the old age survivor disability income portion of Social Security tax. And the Medicare, there is no cap on it. It's on your last dollar of income. If you make millions and millions of dollars, it's still subject to the Medicare portion of that tax. But again, we have that's 5, 6, maybe 7 chapters down the road. So let's begin with our discussion on chapter 1. Okay. I have the ebook, so I have to look at my computer here. And it's an introduction entitled An Introduction to Taxation. 5 learning objectives: demonstrate how taxes influence basic business, investment, personal, and political decisions. Discuss what constitutes a tax and general objectives of taxation. Describe the 3 basic tax rate structures and calculate tax, identify various federal, state, and local taxes, and apply appropriate criteria to evaluate the alternative tax systems. Okay. Again, there's various ways to tax items. You can tax net worth or wealth, or you can tax income. The federal income tax is an income tax based on the person's income. Over the years, you may have read or been aware of discussions or politicians, even though they like to be called elected officials, call them what they are, politicians, come up with various alternatives that catches public opinion. A flat tax. Well, Pennsylvania's income tax is a flat tax, 0.037, I believe, maybe 371. I don't know. The problem is, what is income and what are deductions? That's where the problems come in. Who was it? Steve Forbes, when he ran for president, I don't know, 20, 30, 40 years ago, he said he was going to have the income tax form code reform so it could fit on a 2x5 note card, and you just have to send that in. There's talk now about replacing it with an ad valorem tax, which would be a national sales tax. Again, the problem is, what are we going to tax? We're going to just tax necessities of life like we do in Pennsylvania. I'm sorry, everything except the necessities of life like we do in Pennsylvania with the sales tax, or other states tax everything. Medicines, clothing. In Pennsylvania, food, unless it's prepared for takeout, is not subject to tax. Clothing, housing, basic necessities of life are tax exempt. Medicines, some states tax everything that and different rates. But I didn't get I got to go back up to turn this page in this ebook. Everybody is affected by taxes, even the people that don't pay them, because it impacts what you pay for a product or a service. It also impacts where you choose to live, what type of business format you choose to have, and whether you should buy or lease a car. In Pennsylvania, it's a 9% tax if you lease. If you buy the car, it's subject to a 6% sales tax. All right. Now, basically, government needs tax money to function. So we have to pay for government, and there's different ways they get that out of us. For the road construction and maintenance, maintenance, there's a tax on gasoline. We're currently paying, about $3.70 for a gallon of gasoline. About $1.50, $1.60 of that is federal and state tax. I think the federal tax is about 40 cents a gallon. The state tax probably be around $1.20, $1.10, $1.15 a gallon. So yeah, a lot part of that is tax on the each gallon sold. Okay, so over on page again, we have a screwy page numbering system on this book. My ebook actually gives me a sequentialing number, but I think most of the other books, they give a 1-3. So it'll be on 1-2. Let me scroll up here. There's some bullet points towards the bottom of that. The role of tax is not limited to personal finance. Taxes play an equally important role in the fundamental business decisions, such as the following. What organizational form should a business use? Proprietorship, partnership, corporation, LLC. Where should the business be located? How should the business acquisitions be structured? How should the business compensate its employees? What is the appropriate mix of debt and equity for the business? Should the business rent or own its equipment and property? How should the business distribute profits to its owners? And again, we'll talk on some of these things, but basically, function of taxes is to pay for the cost of government. The other thing taxes have been used for, especially in the IRS code, is to influence behavior among the citizenry, encourage certain behaviors and discourage others. Alcohol, tobacco, firearms is under the IRS is actually under the U.S. Department of Treasury. It's a bureau. I believe it's a bureau, Internal Revenue Service. Anyway, it's under the cabinet position of Secretary of the Treasury. Secretary of Treasury has a lot of or the Department of Treasury has a lot of departments on it. No, it's a department itself. It has a lot of bureaus under it. So IRS is a bureau, as is ATF, Secret Service, a whole lot of other things. Um, so they give you a deduction if you itemize for your home mortgage interest because they want to encourage home ownership. They allow deductions for your real estate taxes if you own a property. Um, they make interest on municipal bonds tax exempt by law because they want to encourage people to buy municipal bonds to help finance state and local governments. And that's why those rates are usually a bit lower than the corporate bond rates. There's a tax on alcohol, and it's pretty severe because they want to discourage drinking. There's a tax on cigarettes because they want to discourage cigarette smoking and other tobacco products. I guess they raised it too a little bit. Again, they have a little bit thing, taxes in the real tax policy, Republicans versus Democrats. Traditionally, historically, Democrats like to tax as much as they can so that they can control, have as much power as they can possibly gather, and say we'll take care of your cradle to grave. The Republicans, the other side of the coin, minimum taxation, and leave you of your hard-earned money, and to do with what you wish. And again, you can look at the websites they allude to there. Next topic is what qualifies as a tax. There are three components there. The bullets just above the key facts on would be page 22 or page, this will tell me. Oh, come on. I'm having trouble navigating here. No, they don't have it on the top. Oh, yeah, page 1-4. Key components to have something be defined as a tax. Number one, it is a required payment. It is not voluntary. Number two, it is imposed by a government agency, federal, state, or local. And three, it's not tied directly to the benefit received by the taxpayer. So things like putting money in a parking meter is not a tax. It's a user fee. Paying a toll on the turnpike or over a toll bridge is a user's fee. It's not a tax. You can avoid it by taking some road other than the turnpike or crossing the river at some other point that doesn't have a toll bridge on it. Hotel tax in Luzerne County, 26 years ago, we built the arena. They appropriated the Luzerne County government, put a tax on hotel rooms to help pay for the construction of the arena. Well, you don't have to stay in a hotel in Luzerne County. You can go up to Lackawanna County or down to Schuylkill County, or just don't keep driving on the road. Don't stay in a hotel. If you stay in a hotel in Luzerne County, you pay a tax to. It's called a hotel room tax. I'm not sure. Does that qualify? Yes, it has a direct benefit because you're using that hotel room. So it's more of a user's tax, user's fee, although most people refer to it. Speeding ticket, that's a fine because it's breaking the law. It's not a tax. Okay. Again, in the key facts there, what qualifies as a tax? The general purpose of taxes is to fund government agencies. Secondary, as I said, is to encourage or discourage certain behavior among the citizens. Unlike fines or penalties, taxes are not meant to punish or prevent illegal behavior. However, sin taxes are meant to discourage certain behaviors. As I said, the taxes on alcohol and tobacco products. Again, it has to be required, imposed by a government agency, and not directly tied benefit. There's Luzerne County, we have these signs all about, and the rain tax, because of the sanitary sewer authority needs money to put in new sewer lines for rain water runoff. Again, that's a benefit to us that we don't have flooding in our roads. So it's a direct benefit. It is technically not a tax. It's more a user fee. You go to one of the U.S. Park Services park, Yellowstone National Park, you pay a fee to go in it, or Yosemite. It's not a tax. It is voluntarily on your part, and you're getting a benefit of enjoying the beautiful scenery of the park and the wildlife and all that. Um, Earmarked tax is a tax assessed for a specific purpose. That would be the tax on gasoline. It's supposed to go for road and road improvement, although a lot of it does go to Philadelphia for the Southeast Pennsylvania Transportation Authority to run their rail systems and their bus lines. Okay. You can read the examples. Like I said, the book has some nice examples, a lot better than the examples you find in the IRS publications. In its simplest form, how to calculate a tax. You read the law, and there'll be a basis. It'll describe a basis of what is being taxed and a rate, the amount, the percentage by which you're going to apply to the basis. So the formula there is kind of simple: tax base times the tax rate. For the income tax, it's taxable income, and the rate varies depending on how much your taxable income is and your filing status. More on that in future chapters. Again, I like this book because of the examples. I also like the fact that they give key facts. What I'm going to be doing is I'll be sending out, for each chapter, I'll be sending out you a shell outline that help you, as you go read through the chapter, you can fill it out, and it will highlight the important points of the chapter. Um, I believe I have PowerPoints I'll be sending out for you to that'll complement the chapter. I also suggest that before you read the chapter, you go back at the end of the chapter, right after the chapter text ends, but before we have the discussion questions, you'll find key terms. Look at those key terms, maybe write them down, and so they stick in your mind as you read the chapter. If you want to define them, all well and good. Again, most of them you'll have heard of them or be somewhat familiar with them, or you can almost guess at the meaning. Some will not be so clear. But again, that will help and aid your understanding of taxes. Okay. Underneath the key point there on page 23 or 1.4, whatever it is, different portions of tax, different rates. Single tax rate applied to the entire base is called a flat tax. That's what the Pennsylvania income tax is, as well as our local municipal earned income taxes in Pennsylvania. I don't know where you live. I live in Shavertown. I think my earned income tax is 1.75%, something like that, 1.5. But I think they raised it, and that is only on earned income. It's not applied to any of my investment income or my retirement income. Same thing with Pennsylvania income tax. They only tax earned income that's off your W-2 or your Schedule C if you're self-employed. It does not affect my retirement. Pennsylvania does, however, tax interest and dividend investment income, but not retirement income. So there's a good example of things that, my federal tax, my pension is taxable. In fact, some of my Social Security is taxable because if you get over, I forget what the number is, it's somewhere in the 30,000, 32, 35,000. If you're over that, then your Social Security gets taxed at a graduated amount. Graduated taxes. That is, as the income goes up or the tax base goes up, the percentage goes up. There's two variations of that, progressive and regressive. That the higher earners get taxed at a higher rate, the lower earners at a lower rate, and low earners not at all of that. In fact, they get some money back. You've heard the word brackets. It's designed there. In fact, if you get the ebook and you see any word that's highlighted, if you put your cursor over it and click on it, the definition will come up. Brackets is a subset or portion of the tax base subject to a specific tax rate. Brackets are common to graduated taxes. I believe right now, we'll see this coming up. I believe there's 5 rates currently as of December 17th. The Tax Cut and Job Act, enacted by President Trump on December 17, 2017, cut rates, increased the standard deduction substantially, almost doubled it, thereby eliminating a lot of people from itemizing deductions. I'm going to be close this year. But as you have these rates, in fact, you'll hear a lot of people say, I just heard somebody on the radio the other day on one of the talk show that it doesn't pay to work overtime anymore because it all goes for taxes. Well, it doesn't all go, but you actually pay more because the tables of how they figure the withholding, they're withholding more, but when you file, you should get some of that back mostly because they look at your paycheck, your weekly paycheck or biweekly paycheck. If it's over a certain amount, there's how much they're supposed to withhold for you. And if they, your normal check is 2,000 every 2 weeks, that's 52,000 a year. But if you worked extra and you get 3,000, well, then that looks like you're making 70,000 a year, and they'll hold out as if you're in the $70,000 bracket as opposed to the $50,000 a year bracket. The brackets are spaced out, and once you get into a higher bracket, the income above a certain level is taxed at a higher rate. It doesn't mean that the first or any bracket lower, and again, I think there's 5 brackets. If you're in the third bracket, only the income in that third bracket is taxed at the third bracket rate. It does not affect the second bracket or first bracket rate income. They're taxed at lower rates. So it gets a little complicated, but they have a pretty good system to handle it. There's 2 ways you can figure it. You can go to tax tables, which are IRS publications, and you just look at where your taxable income is, and across the top, your filing status, and where the row and column intersect, it will tell you what the tax is on that level of taxable income. The other way is to use the tax schedules, which appear in, I believe, Appendix A or Appendix D of the textbook. And it will show you what the rate is plus a percent of any amount over the threshold limit on that bracket. And if you use a computer, these things are already built in to prepare your taxes, which most people do nowadays. Different ways to measure tax rates. This gets a little, complicated, confusing. They come up with all these things. Marginal tax rate. Marginal tax rate is a rate on your last $1 of income. Okay? It's a tax that applies to the next additional increment of a taxpayer's taxable income. That's even a little complicated. All it is your marginal rate is the rate you're paying on your last $1 of taxable income. Okay. Another one they have here is what do they call the average tax rate and your effective tax rate. Marginal tax rate. I missed it. Let me scroll up here. Again, this ebook is a little hard for me to navigate. Well, you can see in Exhibit 1.3 there, they have, that's an excerpt of the tax table, not the tax schedule. You can see not over $20,550. If you're married, filing joint, or surviving spouse, that's a filing status, which we'll get to in later chapters. It's a 10% rate. Then between $20,550, but not over $83,550, the tax would be $2,055 plus 12% of the amount over $20,550, which is the threshold, the beginning of that bracket. And you can read that table as it goes up bracket by bracket. You can see the rates go up 10%, 12, 22. So the 10% to 20, 32, 35, and 37. So there's 7 brackets currently. That is subject to change. And those numbers in the bracket, they're important only for the 2022 tax year, because those numbers will usually be indexed for inflation. So just know that the brackets are spaced out based on taxable dollar amount, taxable income dollar amounts, and also the rates may be subject to change at some point in the future. I know they're going to change in the future. Whether they go up or down, I don't know. I hope they go down. Very likely they won't. So as I say there, note that in the graduated tax structure, the first $20,550 is taxed at 10%. The next $63,000, the amount between $20,550 and $83,550, taxed at 12%, because that's the second bracket. And as you climb the brackets, the rates go up because it is a progressive or graduated tax. Okay. So the marginal rate for them, for Bill and Mercedes, is 22%. That's the amount on their last $1 of income, taxable income. Average tax. Average tax is, or the average tax rate is just a total tax divided by taxable income. Okay. And again, key facts, they give you the formulas how to compute these things. Some of them have to be computed, like the average tax rate, the effective tax rate. Uh, the marginal tax rate, you can just look at the bracket, what bracket you're in that rate. Okay. So they have marginal tax rate we discussed, average tax rate we just discussed, and the final one is the effective tax rate, is the total tax over total income, which is different from the average tax rate, which has taxable income in the denominator. The effective tax rate uses total income. Not all income is taxable, as we will find out. Now they talk about tax planning strategies and limitations on some of these things. Okay. And again, right there, we see it, the average tax rate computed. It's in the key facts above. But the average tax rate is the taxpayer's average level of taxation on each dollar, not the last dollar, every dollar. So it can be somewhat deceiving if you're depending on how many brackets your income covers. And then the effective tax rate is, as we saw up above, total tax divided by total income. And it's the average rate of taxation for each dollar of total income, taxable income and non-taxable income. Yeah, would be nice to have a lot of taxable income. Invest in municipal bonds, of course. You have to make money to do it. Over on page 1-9, they have a chart that shows you the proportional tax rate, also sometimes referred to as a graduated tax rate. And as you can see there, the tax base going on the horizontal axis and the tax or tax rate are going up the vertical. And as you move out this way horizontally, meaning as income goes up, the tax base, the rate goes up. Okay. If you're like graphs, that makes it easier to understand. If you don't like graphs, it makes it harder to understand. Again, simple thing is graduated tax rate. The more the tax base is, the higher the tax you are in the tax base, it gets taxed at a higher rate. Proportional tax. The tax base times the tax rate. The formula there, equation 1-5. They give you an example. Progressive rate, again, they give you a table. As you go up the tax base, the rate goes up, and the average will tend to go up, but not as fast because it's an average. A regressive tax structure that taxes the lower income earners more. It's a tax rate that imposes a decreasing marginal rate as the tax base increases. Most people think that's not a good deal. I think it is, because it gives you an incentive to go out and work extra, take a second job, take a third job, or whatever. It gives you incentive to earn more. As the tax base increases, the taxes paid increase, but the marginal rate decreases. Key facts: tax rate structure: proportional, progressive, and regressive. Okay. Turn the page here. Types of taxes. Federal taxes. Okay. We have the federal income tax, and we have Social Security tax. We have federal gas tax, pay for the interstate highway system, Medicare, Social Security, retirement, benefits for disabled people. There's a lot of, the federal they have excise taxes. They say they have no sales taxes. There's excise taxes. That's what the tax on alcohol and tobacco, gasoline are excise. They're referred to as excise taxes. They have here value added, also sometimes known as VAT tax. That is a tax imposed on the producer of goods and services based on the value added at each stage of a process. Think about one company's raw materials or one company's finished goods are another company's raw materials. So say you're a steel company, you're making stainless steel in big rolls that you may have seen on tractor trailer trucks. Well, the value you add to that is taxed, and you pass that on to, say, Whirlpool, that you're going to use that stainless steel to make refrigerators, the outside of a refrigerator. Well, what they take and cut it, bend it, and do whatever they have to do to it, form it, shape it, treat it, whatever value they add, then that's taxed. And Europe is big on that, and that's why things cost is so much in Europe, because they also have socialized medicine, which we're moving to. So their income taxes are a lot higher. Their marginal rates are a lot higher than ours. A few years ago, when I did tax preparation for people, I don't do it anymore. I had a Canadian fellow, and he was surprised that when I sat down and went over his return to me, he said, "Oh, that's not bad at all. I pay a lot more up in Canada." And it's funny, they talk about it. They don't call it America. They call it the States. And he said, "Oh, it's not too bad down here in the States." He says, "I'd expect to pay more," because he has experience growing up in Canada, where, you know, their lower rates, lower income, are taxed at a lot higher. Their higher rates are taxed at a lot higher. I mean, at one time, our top rate was 70% on individuals. Right now, the top rate is 37%. So again, these rates move up and down with the needs of the government and the economy. Employer taxes, employment taxes. You have the Social Security that's half paid by the employee, half paid by the employer. You also have unemployment taxes that are paid by the employer, and workman's comp taxes. Okay, so there's a lot of taxes out there. Excise taxes, transfer taxes. You buy a piece of you buy a house. The buyer and seller have to pay 1% on the value on the sales price of the house. Other transfer taxes are inheritance taxes. What's the other one? It's a death tax. Inheritance, estate taxes. There's a little difference in those. One is taxes the individual receiving it. The other one taxes the property of the decedent. Gift taxes. I think currently you can give somebody $15,000 a year tax free. Above that, you have to pay a gift tax. And again, you can have multiple people do that. If you have parents and both of them rich, one child, mom and dad can both get $15,000. Again, that may have been raised. That's the last time I did any looking into it. It was $15,000. It used to be $10,000 for years and years and years, and then they raised it. Now, again, a lot of times on the estate tax, there are exclusions. The federal estate tax doesn't kick in until, I believe, you're over $1 million or $11 million, something like that. So it doesn't affect too many people. Here in Pennsylvania, the inheritance tax, it can be given to a spouse tax-free. Surviving spouse gets all the property of the spouse that died, no tax. Children are taxed at a rate, but it's the lowest rate. I don't know what it is, 3%, 5%. Siblings pay on the same property would pay a higher rate. I believe it goes up to about 15%. And again, it's based on relationship to the decedent. There's a nice exhibit 01-4, breaks down where the federal government gets its tax revenues from. Half of it, the individual income tax. Next one is the employment taxes or Social Security, 32.6%. Corporate income tax 9.3%. Other taxes 6%, and the excise tax 1.9%. Just a little informational blurb there. One thing I don't have it readily available. I'll try and figure it out. I might have it over in the office. I haven't been in the office since last week because of the semester break. I'll have a table that shows who pays what. The big thing with the politicians always gets my goat is to make the rich people pay their fair share. Well, I'll get you stats that'll show that the rich pay more than their fair share. In fact, this breakdown, if I can find it for next video I send you, it's somewhere around 47% don't of the population do not pay any federal income tax. They get a refund back, or some people get more than what was withheld from their paycheck because they get the earned income credit. Um, just off the cuff, I think it's something like the top 10% of wage earners pay close to 50% of the income tax paid to the IRS. All right. Okay, there we're talking about the employment, unemployment taxes, Social Security tax, Medicare tax. Again, the combined, it's 12.4%, 2.9% presently. And the cap with Social Security is capped at 147,000. I think I said earlier, I was using old numbers, and I thought it was 130, somewhere in the 130s. It's now up to 147. That's on the Social Security portion only. The Medicare tax, which is 2.9%, there is no cap on it. It's on as much as you make, millions and millions of dollars. Not only that, once you get up high, they put a 3/10% or 0.3% surcharge on it. I'm sorry, 9%. They raised that up to 0.9% surcharge on the Medicare for higher income individuals. So there's the breakdown: 6.2% on the employee, 1.45% for the Medicare tax on the employee. The employer has to match those amounts. Federal unemployment tax, FUTA, is 6%. If you look up the Social Security, up the top of that, right under the employment, unemployment headings, the second sentence, the old age survivors disability insurance, OASDI, that's the Social Security tax. Everybody calls it the Social Security tax, but that's the technical name. Is the old age survivors and disability insurance, and it also has the medical health insurance tax included in it. Okay, Social Security and Medicare combined on one thing. Excise transfers tax, pretty straightforward. State and local taxes. There are 4 states that do not have an income tax. The other 46 have various forms of it. Some only tax investment income, some only earned income, some both. Like I said, Pennsylvania doesn't tax retirement income or pensions. A lot of jurisdictions have sales taxes. Philadelphia County has its own sales tax in addition to the Pennsylvania sales tax. They have all other things they call a use tax, which is equivalent to a sales tax, but it's when the selling party has no obligation to charge and collect it. Then the purchaser is obligated to send that amount into the jurisdiction in which they live. For example, if you buy something online from a company in Nebraska that has no connection with Pennsylvania, and there would be a taxable line in Pennsylvania, you're liable to, and you're supposed to send in a use tax to the Pennsylvania Department of Revenue on those goods that, had you bought them in Pennsylvania, would have been subject to the Pennsylvania state sales tax. So local and local governments, local school districts, county governments tax real estate, your home and the land on which your home is built, and the value of your home. Again, it's some people, 10, 15 years ago, Luzerne County, which we're located in Misericordia campus, and my house, they did a reassessment, and I have a nice house, but there was a fellow out in Harvey's Lake, right on the water, had a brick house, the same size, if not bigger than mine, that was paying less tax than I was. Where I used to live, a lot of people there, was a newer housing development. They were higher than the rest of Wilkes-Barre, but when they did the reassessment, their taxes went down. The reassessment is an attempt to try and get equality and just to update values. I used to work up around the country when I was a corporate tax auditor. Connecticut, we were working with a fellow. He said if you live within a 1 square mile or a 1 mile radius, if 3 properties are sold, everything within that circle is reassessed based on the selling price of the house that's sold. So Connecticut is a high tax state. You might be wondering, what are the 4 states that do not have an income tax? I'm not sure, but I know it's Florida, Texas, Alaska, and Nevada. I'm pretty sure those are the four. Obviously, Alaska, they get all their revenue from the oil industry, as does Texas. Florida makes it on taxing tourists because that's their big industry. Nevada, they probably get it from gambling, or the gaming industry. So again, you could have an income tax. Most places you're going to have the federal income tax, you're going to have the state income tax, you're going to have the city income tax. New York City's income tax is almost as high, if not higher, than the New York State income tax, and it's pretty complicated form. Pennsylvania, we just pay on your W-2 for your local earned income tax. State income tax is your W-2 earnings, or if you're self-employed, your Schedule C, plus your investment income. As I said, your pension is not taxable in Pennsylvania. So again, a lot of variations between jurisdictions. It's one of the reasons Florida is attractive to people, especially people that are retired, is there's no income tax. A lot of people retired. Hopefully when you're retired, you have a lot of investment income. It's not subject to income. Pennsylvania, my pension's not subject to income, but my investment income is. If I go to Florida, I not only get the better weather and hurricanes, worse weather, none of my income is taxable. So they give you a summary in the key facts: income taxes, state and local use taxes, state sales and use taxes, property taxes, and excise taxes. And they discuss each one of those at length after that. Some of the jurisdictions, in fact, Luzerne County used to have a personal property tax on your investment portfolio, on the net worth of it. Pennsylvania Department of Revenue used to tax corporations. They used to have two taxes. They had a corporate net income tax and a corporate income tax, and they also taxed you on the value of the corporation. Called the capital stack or franchise tax. I believe South Carolina taxes you on, they put a tax when you renew your license plate every year based on the value of the vehicle you're driving. Again, their property taxes, because of that, their real estate taxes are lower, but they get it in, people would have 2 or 3 cars, especially if you have a luxury car, or, pickup truck and a Corvette and a Rolls Royce. You're paying a lot of tax based on the value of those vehicles versus somebody that's driving just a Hyundai or a Kia. Explicit, implicit taxes. Explicit taxes are those taxes that are directly imposed by a government. Implicit tax is, it's not open for me here. And then implicit tax is indirect tax is a result from a tax advantage the government grants to certain transactions to satisfy social, economic, or other objectives. They're defined as the reduced before tax return that a tax-favored asset produces because of its tax advantage status. Tax advantage status, as we'll see in upcoming chapters, dividends are taxed different rates depending on your taxable income. It is possible, if you have low income and have some dividend income, that you pay 0 tax on your dividend income. It is pegged to your taxable income. It goes, and the max is 15%. If you're in the 37% bracket, if you're W-2, or if you're self-employed and you're making $1 million a year, you're going to be taxed. Your marginal rate is going to be 37%, but the most you can pay on your dividends is 15%. Well, again, long-term capital gains, we'll get into that in upcoming chapters. Long-term capital gains get desired preferential treatment. Reading that page will explain a lot of that other stuff. I don't need to read the book to you. You can do that at your own. In fact, I suggest reading each chapter twice. Read it before you view this tape, and then read it again after you view the tape. It may make a little more sense. And again, you might think that's silly, but myself, I know I'm a fan of Old West movies, and especially John Wayne. I've watched a number of his films over and over and over again. I was watching TV yesterday, and one of the channels I had a talk show on, and The one lady said she saw Maverick, Top Gun 5 or 6 times. She loves the movie so much. And again, every time you watch it, you pick up something you missed the first time around. Evaluating alternative tax systems. Okay. Um, Believe it or not, Congress and IRS, they try to make it as fair as possible. And you ask anybody, the only tax that is fair is the one that gives me the lowest amount and everybody else the highest amount. But one of the things we're looking for is what they call sufficiency. Okay, it's a standard for evaluating a good tax system. Sufficiency is defined as assessing the aggregate size of the tax revenues that must be generated and ensuring the tax system provides these revenues. And obviously, we don't do that in this country, as we are constantly spending over budget and spending money we don't have. Big topic now is they want to raise the debt ceiling again. It's only exacerbating the problem, in my opinion. They have to lower things. Live with why can't they be like us and live within our means, live within our budget? Static versus dynamic forecasting. Static forecasting is the process of forecasting tax revenues based on the existing state of transactions while ignoring how taxpayers may alter their activities in response to a tax law change. I'll give you an example of that. Years ago, I had a client that was working part-time. Her husband was self-employed plumber. She was working part-time in a drugstore. They offered her full-time. She said, should I take the full-time job? I said, why are you asking me? Yeah, well, it's a no-brainer. You make more money, probably get some benefits. And she says, yeah, but we'll probably lose our earned income credit. So she was thinking about how much it's going to cost her in tax. Well, if you're making $5,000 a year part-time, full-time, you go to $10,000 a year, and your taxes are $2,500 on the $5,000 and $3,500 on the $10,000. Yeah, you're going to pay $1,000 more in tax, but you're going to make $5,000 more in income. So you're going to net $4,000 to the good. People just don't realize that. They just look at how much they're going to give the government. They don't think how it's going to affect them. Yeah, you're going to pay more tax, but you're going to be better off. Dynamic forecasting is the process of forecasting tax revenues that incorporates into the forecast how taxpayers may alter their activities in response to a tax law change. Years ago, when the Affordable Care Act came into existence, I was playing golf with a doctor whose son happened to be a doctor too, and I know quite a number of doctors, and a lot of them were unsure of how this was going to affect things, the Affordable Care Act, and a lot of them were going to say. I had one guy say, "I'm going to work through April or May, and then take the rest of the year off because after that, I'm not going to get reimbursed as much for everything and the tax, blah blah blah." It was really a screwy thing. In fact, the Affordable Care Act, as the Supreme Court said, is a tax act. And that's why it's constitutional. Justice Thomas, I believe, came up with that. I was at a seminar, and if you had 3 families, A, B, and C, and the tax is based on the income of the family, household income. So if you didn't get the tax, family A could have been penalized $500 as have to pay a $500 tax. Family B $1,000, and family C $1,500 for breaking the same law. And the person giving the seminar, I said, well, where's the logic in that? I said, if all 3 people are going 15 miles over a speed limit, they're all going to get pulled over and pay a $175 fine for breaking the law. Yet this one, they break the same law and they pay different penalties. Somehow, I don't think that's constitutional, but or not only not constitutional, it's not fair. But that's how the rules are sometimes. Income versus substitution effect. The income effect predicts that a person are taxed more, they will work harder to generate the same after-tax dollars. Substitution effect predicts that when the taxpayers are taxed more rather than working more, they will substitute non-taxable activities. And again, yeah, that's probably split 50-50. Again, everybody's in a different, case-by-case basis. I work more, I'll pay more, but I'll have more. But do I really need it? No, I'm not going to do it. It's not worth it. I'm just working for the government, not working for myself. Basically what they're saying. Uh, and we're talking about the debt ceiling, raising it, taxing real national debt. How much debt does the U.S. have? Is 28.6 trillion too much to handle? Yeah. Uh, how much? And they say, "Oh, don't worry about it. Don't worry." Right, right. We'll be dead. It's gonna be our kids and our grandkids that have to worry about it. Equity, fairness is what equity means. Is it applicable to all? Um, there's no one size fits all. But again, if you ask somebody what's fair, taxes aren't fair because I pay more than I should. But everybody would say that. They try to strive for equity in it that, people that fall in the same bracket in the same circumstance pay the same amount. Horizontal versus vertical equity. Two taxpayers in similar situations pay the same tax. With horizontal, vertical, we'll give you some examples there. Vertical, second type is vertical equity is achieved when taxpayers with greater ability to pay tax pay more tax than taxpayers with less ability to pay. And that's pretty much how we're designed here. I don't like that a little bit. I worked with a guy, again, he was an auditor, accountant, trained, educated accountant. And he says that's how it should be. People that pay more or that make more should pay more, have the ability to pay more, should pay more. I don't know. And I told him, how could I get the point across to him? He would lease his vehicles. And I said, all right, next time you go lease a vehicle and they come out and they tell you it's going to be $400 a month, you tell them, no, you want to pay $500 because you make more than the average person. So again, that would be people in the same situations, I would think. But again, that I see a twinge or a little taste of Marxism, socialism in that, and gives me a bad taste. Certainty. Whoops. Gotta scroll up here a little bit. Certainty. Certainty means that taxpayers should be able to determine when to pay the tax, where to pay the tax, and how to pay the tax. The instructions go over that in the IRS publications, and we'll get into that. Yeah, there's no doubt about how much you're going to have to pay. Okay, there's formulas, and there's due dates, and addresses, different amounts, different returns go to different addresses across the country. I'm just cleaning out my home office here, and I had a whole bunch of old IRS envelopes with the address on them that I'm throwing out because they've changed it. A lot of the stuff in here used to go to Philadelphia. I think they closed the Philadelphia office or they changed it. Sometimes now some of my stuff goes out to Kansas, and estimated payments used to go up New England somewhere, and now they're going out to Idaho. So convenience. Convenience suggests that a tax system should be designed to facilitate the collection of tax revenues without undue hardship on the taxpayer or the government. Well, some people give me an argument there. In fact, the IRS has Congress put something on them where when they come out with a new form or something, they have to do an estimate how long it takes you to complete that form. And I laugh every time I see it because again, maybe it's because I know something about the one form that says it should take you an hour and 45 minutes to collect this information and put it on the form, fill the form out correctly. And I'm like, no, that's like 10, 15 minutes for me. Now, again, maybe I because my background in training and education, I can do it better. Is it easy? It can be. Easy returns, uncomplicated short forms, and sometimes you can get a tax form that is 20, 30 pages. I've had my own personal ones. When I was a tax auditor, I forget who, I think it was AT&T we were at in New Jersey. We asked to see the tax return. He said, well, I'll have to bring it down in a shopping cart. That's how big the physical, because they had tons of subsidiary country, it was thousands of pages for their consolidated tax return for AT&T. Economy requires that a good tax system should minimize the cost of compliance. Well, what are they doing now with the new party in charge? They're trying to repeal the law that was passed last year. They said 87,000 new IRS agents. I don't think it was all agents. It was also behind the scenes people that the data entry, data processing, which they sorely need. But do they need 87,000? You know, and they were trying to, politics again playing a part in it. 87,000 agents armed with sidearms. I don't know if they had 9mm or if they're going to give them 45s, but only the criminal the IRS people, auditors, I know, the only ones who carried guns were the criminal investigators. So, believe it or not, most tax systems fare well in terms of economy. Yeah, it's self-reporting. You have to fill out your tax return. You can pay somebody to do it, but you know, it doesn't cost. The government has to pay print the forms up, but they have costs involved in receiving the forms and checking everything and cost matching. And again, a lot of that is done by the computers now, but they still have to have human beings that are very expensive employees to input all the stuff that's coming in. Again, you have a W-2, you put it on your return, but a copy of that W-2, whoever you got it from, your employer, sends a copy of that to the IRS. That gets inputted to the database, and the computer does a match. The same thing with the 1099s. All right, we've come to the conclusion of the chapter. When I get you the syllabus out, there will be some assignments towards the end of the syllabus of what discussion questions we're going to be doing. I'll do that in a separate YouTube. There's at the end of the chapter, there's a summary, which would be kind of nice to read, broken down by learning objectives. And then we get into the glossary of key terms, I believe, key terms. And they have all these things. I have the ebook, so I click on them. It gives me the definition. I would look at those before you read the chapter. They're on page 30 or page 1-24 or 1-25. And it helps you focus on some of the key concepts touched on in the chapter. And then we have the discussion questions. I don't know if we have any problems at the end of chapter 1. No, it's all. No, I shouldn't say that. Let me turn the page. Yeah, there are some problems there at the end of chapter 1. So every chapter is set up like that. You'll have the storyline at the beginning with the learning objectives at the beginning, the body of the chapter discussing things, and then you'll have the conclusion, then you have the summary, then you have the key terms, and then you have the discussion questions and problems. So I'm going to be ending this video for now. Next time I send you one out later in the week. I don't know if you have the textbook yet, but we'll be going over the discussion questions and problems to reinforce some of the concepts covered in the chapter. I will be sending out along with this video, I'll send you a email with the link to this video so you can watch it. And I will be sending you, like I said, a shell outline and I believe I do have PowerPoints that will go, and I'll do that for each and every chapter. All right, enjoy.